So where do we start? Well, let's make it the Bank of England's interest rate decision. Now, originally we weren't planning to highlight this. It comes out on the 6th of November at 2 p.m. GMT +2. And the reason we were thinking about not highlighting it was pretty much because almost every analyst expected no change. But a new forecast from Goldman Sachs has really stirred the pot, as investment bank now expects the Bank of England to cut interest rates. Now, Goldman's analysts argue that fading inflation pressure and sluggish growth may push the bank to act earlier than expected. Now, inflation came in at 3.8% in September, which was below the forecast of 4%, whilst pay growth is also cooling. Unemployment is rising and overall economic activity remains somewhat weak. Now, Goldman's also cited concerns over Chancellor Rachel Reeves' upcoming budget. That's the 26th of November, and is expected to include some major tax increases and spending cuts. Now, they warn that this could have, and we quote, a large contractionary impact on the UK economy. So has that changed things? Well, markets are now roughly pricing in a 1 in 3 chance of a rate cut from 4 to 3.75%. If the bank doesn't cut rates, which is still the main expectation, another important factor to watch will be the Monetary Policy Committee's vote distribution. And that basically says who voted which way. Now, markets are almost certain that the next cut won't happen until 2026. However, if more than expected MPC members vote for a cut, that could weaken the British pound, as it could well signal that the cut may happen in December, i.e. next month, instead of 2026. Also keep an eye out for the actual policy report as well, which explains the MPC's economic output and policy rationale. Any unexpected projections could well add to market volatility.